What's up, people? Welcome back to the channel. My name is Tevi, and this is Invest with T-Claus. So the focus of today's video is going to be on ChargePoint. In my intro video, you've heard me talk about ChargePoint as one of my cornerstone stocks along with Tesla, Nio, and Virgin Galactic. And at the time of the recording, ChargePoint has achieved a 370% gain year to date. But past performance, though it's a good indicator for where the stock could go, what really matters is future performance and where we expect the stock to go over the next few years. So in this video, I'm going to talk about what has me so excited about ChargePoint as a future investment opportunity. We'll start with who they are and what they do. Then we'll hear from their CEO on their trajectory. I'll add some comments where I see fit. And finally, wrap up with some near-term catalyst and where I expect the stock to go over the next 5 years. Okay, all right, let's jump into it. So who are they and what do they do? ChargePoint is the leader and largest manufacturer of EV charging stations in North America. They've been in business for 13 years now and actually started building the infrastructure for EVs even before mainstream EVs that we take for granted today were introduced. Think about the Nissan Leaf, that was in 2010, the Tesla Model S, that was 2012, the Chevy Bolt, that was 2016, and even the Tesla Roadster, that was in 2008, so a year after ChargePoint went into business. But instead of just listening to me tell you who they are, let's hear directly from them on who they are, what they do, and what their mission is.
What kind of company builds an electric vehicle charging network even before the first mass-market electric vehicle rolled off the assembly line? Okay, we admit it. It's us. We're ChargePoint. And our passion, no, our obsession is helping everyone make the switch to electric mobility. We see this moment in time as an opportunity to change the world for the better. And since change is hard, the best thing we can do is build a robust network that makes it easy for people to switch from the old way to the bright and shiny new way. And that's what we've been doing since 2007, designing a charging experience for businesses, fleets, and drivers that is as easy, convenient, and seamless as possible. We've built North America's largest charging network, and we're rapidly expanding in Europe. We've worked with everyone from automakers and utilities to policymakers and influencers to pave the way for EV ubiquity. And we've developed advanced software that makes the charging experience simple. This is way more than just business to us. Electric mobility means cleaner air. And what's more important than that? We'll be dreaming and driving and innovating new ways to make the EV charging experience as user-friendly as possible every waking moment we have. We can't help it. That's just who we are. ChargePoint.
So as they said, they've been building this network for 10 plus years now. And to give you a really good sense of how big they are compared to the competition, let me bring up this on the screen. The closest competitor to them is going to be SemaConnect. And SemaConnect only represents 10% of the market currently. By comparison, ChargePoint has 73% of the market. I mean, that's 7 times, as they say, 7 times bigger than the closest competitor. What's even more impressive here is that if you were looking at building or getting into the infrastructure space, a lot of these players on here are not even publicly traded. The only one on the list that you could invest if you wanted, if you wanted to, is Blink Charging, which right now only represents 8% of the market. Yes, I'm sure they have room to grow, but when you consider that ChargePoint is not only winning North America, but now they're quickly expanding into Europe, there's really no comparison here. You really want to pick the winner, and right now, and for the foreseeable future, ChargePoint is the winner in the EV charging space. In this next segment, we're going to hear from Pasquale Romano, who's the CEO of ChargePoint, on why now is the right time to take the company public.
Pasquale, let's talk about the SPAC IPO that you guys announced today. You're going to be combining with Switchback Energy Acquisition, a deal valued at $2.4 billion. You're going to get, what, basically almost $500 million in revenue to fund your expansion. Why now? Why do you believe this is the right time for your company to go public through a SPAC?
Well, we've been eyeing when to exactly take the company public. We've always had goals to do that And right now, with the market for electric vehicles being now starting to establish and climb that hockey stick in consumer acceptance, it's just the right time to add the capital to the company to really fuel our growth. We're 13 years old. We've been in the market for 10 years selling product. We've amassed 4,000 business customers in that time frame and climbing quickly. And so for us, we had a lot of optionality on the timing. But given the recent, I think, awakening in the investment community that this trend is here to stay, it was good timing for us.
For those of you not familiar with what a SPAC is, at the most basic level, it's a blank check company whose sole purpose is to raise capital through stock offering ahead of the target merger date with their target company. And so, because the merger is not yet complete, the only way to purchase or invest into ChargePoint is to buy the switchback stock, ticker symbol SBE. As far as the timing being perfect comment that Pasquale made, what he's really referring to here is that because of the global pandemic and the multiple stay-at-home orders that were put in place, we saw something that we didn't think was going to be possible, and that is a significant reduction in air pollution. I will link the two articles in the description, but the one that I want to go over briefly here, and I'll bring it up on the screen. If we look at China, there was a 65% reduction in the NO2 emissions, or nitrous oxide, after the stay-at-home orders were put in place. And the quote that's the most interesting, and I'll read here, quote, "This is a pretty good model for what the world would be like if half of us were driving electric cars." I mean, that's pretty telling. And as you can see on the graph, there's a stark difference between 2019 and 2020.
Yeah, at the same time, Pasquale, let's be honest, you guys are not yet profitable. Yes, you had basically $147 million in revenue last year, and I know you're projecting to be profitable a couple of years down the road from here, but by my count, you're at least the sixth EV-related SPAC that's been announced since May. And when I talk with people in the auto industry, people who deal with the EV industry, almost everybody says the same thing. Some of these SPACs are going to blow up in the face of investors. How do you counter that story, that line out there that these are not all companies, and some people would say that about ChargePoint, that should go public right now?
Well, I mean, we're very different. This is an established company. It's had a 10-year track record of shipping product, supporting customers. We are in revenue. We do not have the risks of a pre-revenue company. And more importantly, we're an index for the electrification of transportation, because as all of the existing automakers and the new automakers begin to transition to electric vehicles, that all drives demand for us. So we are broadly attached to the acceptance of EVs. We have very good predictability based on our 10-year track record. We see our revenue directly proportional to the acceptance of EVs. So we think that from an achievement of our financial goals perspective, we have the maturity and the predictability to be able to do that, and it's very different for us.
That is a great answer by Pasquale. 2020 has certainly seen its fair share of EV companies going public, both China and US based, but the reality is not all of them are equal, and not all of them are going to be able to sustain this growth over time. There's a lot of hype currently around EVs. And so what really sets ChargePoint aside from the rest, from the competition, is that they're currently the market leader. Unlike the competition, ChargePoint has been doing this for 13 years now and doing it successfully. They've been growing their revenue stream at a steady pace year over year. And so let's take a quick look at the graph here. So looking at the chart here, you can see that between 2017 and 2019, their revenue and units shipped year over year grew significantly. But maybe even more impressive is how minimal of an impact COVID actually had on their core business. So looking at the revenue and looking at the number of units shipped, we're seeing a drop of about, let's say, 1,500 in units shipped, and only a drop of about $10 million on the revenue side of things. But where things really get interesting is starting next year and beyond. As we look out to 2026, that's what exponential growth really looks like. And going back to the earlier point made about EV adoption and the inflection point being 2021 and beyond, you can see here that China in the light blue and Europe in the green are set to see the most growth over the next few years, going all the way out to 2026. There is no better illustration of how closely tied to EV adoption ChargePoint's success is. And in case you were wondering what 13 years of building partnerships and being the market leader looked like, take a look at this list. I mean, it's pretty impressive. But the crazy part about that list that you're looking at right now and some of the heavy hitters that we're seeing is that it's not all encompassing. They're still building out relationships. One that comes to mind is Hy-Vee, not currently on the list here. And every day, they're growing their network and taking more market share. Okay, so we've pretty clearly identified that ChargePoint's success is directly tied to the EV adoption rate. And by all accounts, it seems like the EV adoption rate should be happening over the next 5 to 10 years. But what guarantee do we have that this will actually go the way that we planned? Well, that's a very good question. I am glad you asked. Let me bring this up. Okay, so what are we looking at here? This chart is courtesy of Pseudocat. And what's really nice about this is that it gives you a breakdown of the government mandates along with the forecast from the transition from from ICE cars to EVs. And at the very top, it shows you the corporate goals for some of the major OEMs and when do they plan to make that transition or at least add some pure EV plays in their lineup. And what's really interesting here is that 2022 is when we're starting to see a pretty big commitment from some of the major OEMs. Nissan here, for example, is planning to have 1 million cars sold, as well as Volvo. But what's telling is that by 2026, right? By 2026, we're saying that EV and ICE cars will be at price parity, meaning that it will be as cheap to own or to buy an EV car than it is to buy an ICE car. What the graph is not showing you, and this is the kicker, is that all these projections for OEMs, like Volkswagen, Ford, and all those people, Tesla is way ahead of them, right? Remember we said earlier that Tesla was looking to introduce a $25,000 car as early as 2022. And the reason they're able to do that is because they're driving their battery cost down, right? So all this is pointing to, what the OEMs and, everybody else is doing. But keep in mind that Tesla and Nio and some of the other pure play EV players are well ahead of this timeline. All of these EVs hitting the road in the next few years are going to need a large network to support their charging needs. And that brings us back to ChargePoint and why they're going public now. They need to raise capital, charge up, and quickly expand not just in the US, but in Europe and beyond. You know what else this reminds me of? Charging up and multiplying quickly.
How was he doing it?
I mean, I'm sorry, people. I didn't mean to keep you waiting this long, but to put it earlier in the video just wouldn't have made sense. And you know what? I'm going to pat myself on the back for this one because to find something that's orange, charges up, and multiplies quickly, I mean, genius. By the way, shout out to all my Naruto fans. All right, let's get back to it. Okay, so let's bring it all back together. What does this mean to you as an investor? Well, the stock price currently at the time of the recording is around $46 and some change. The merger is set to take place on January 15th, give or take a few days. And I expect that because of the run-up leading up to the merger, the stock will probably give back some of those gains in the near term. But then, based on the trajectory of the EV market and where we're going over the next 5 to 10 years, and the fact that they're set to achieve a 60% revenue compound annual growth rate, that right there is how they go from the $135 million achieved in 2020 all the way up to $2 billion in 2026. And when you consider that the stock price currently is at $46, and yes, there's probably going to be a pullback come merger time, which is going to take place on January 15th, give or take a few days there, there's still a lot of runway. And so my projection, and again, not a financial advisor, so take this with a grain of salt, do your own research. But my projection is that this one, ChargePoint, is an easy 5 times your money over the next 5 to 10 years. And that's why ChargePoint is one of the 4 cornerstone stocks in my portfolio. All right, people, this will do it for today's video. If you enjoyed what I had to say and found it insightful, please drop me a like and share with your friends, as this greatly helps the channel. Also, remember to ring that notification bell and subscribe so that you don't miss any future content. Thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.